Hello, everybody. This is Becker here. It's Tuesday, April 19th. Topic for today is investment strategy. The reason I wanted to cover this topic is I'm involved in a few different groups of investment advisors on places like LinkedIn, where different ideas are bounced around. People use other advisors or sounding boards, just general topics. And some of the, I guess, the feeds in there recently have been on investment strategy, or one in particular. And there's been a lot of investment advisors commenting. And I'm absolutely amazed at the number of advisors that still, even after what we've experienced in 2008 and even in 2000, are still on the buy and hold investment strategy. Or, well, it's not really an investment strategy, but the mentality of buying and holding. I say that buy and hold is not an investment strategy. And the reason I say it is because an investment strategy really should have four things involved in it. When do you buy? How much do you buy? When do you sell? And how much do you sell? Buy and hold as a strategy fails because it only outlines one thing, which is when do you buy? You cannot just sit in the market nowadays. And the perfect example of that is if you look at the last 15 years or even 25 years in the market, or further back, quite frankly, if you look further back and go back to the Depression, since the 1900, we've had 40% or more drops in the market. You had a few back in the Depression era, and you've had three, one in the 70s and two in the last 15 years, right? The dot-com blow up and the most recent sell-off. And the disturbing part is people's investment advisors in particular, which really blows me away, they really don't get the true power of the downside in the market. Meaning when you've got a 30 or 40, 50% sell-off in the market, it's going to take a long time to get that money back. And what's sad is I see some of these advisors pointing to, well, look, we had this sell-off in 2008, 2009, and the market's pretty much back now. Well, yeah, it's back because the Fed has bailed everybody out. They're printing money like crazy. But you're not truly back because if you look at the returns of the market priced in dollars, everything looks great because the dollar has been driven into the ground by the Fed. Price the S&P 500 in something like gold, which can't be printed, you can't print more gold, or in oil, or in another currency, in more stable currency that hasn't been printed to oblivion. Then the market doesn't look so rosy. So the point here is you have to have an investment strategy because those big down periods are going to happen. And my suspicion more frequently now that the Fed has stepped on the gas with bailouts and money printing and so forth. So what is an investment strategy? Well, there's a million, and none of them are perfect, right? If there was a perfect investment strategy, we would all use it and we would all be multimillionaires. A good investment strategy is going to protect the downside, is going to manage risk in a portfolio. And why do I say that's important? Well, because risk is kind of turned inside out now. And I'll give you a perfect example. A perfect example was yesterday, Monday, April 18th. I had to look at my watch, sorry. Monday, April 18th, news comes out in the morning that S&P is threatening to downgrade the United States government's credit rating. In the short term, they're willing to float it and keep it at AAA, but they said long term, if you don't get your house in order on debt, we might have to downgrade you. And what happens? The market sells off, but the dollar goes up. Now, how does that work? How they're basically saying, you guys, your currency, your economy is under serious pressure, but yet when the market sells off, the money goes to the dollar. Go figure that one out. It doesn't make any sense. Quite frankly, this nation is bankrupt. It's proven that it's bankrupt. We all know that it's bankrupt, but for some reason, these credit rating agencies like S&P and Moody's and whoever else rates the sovereign credit, like the United States and other nations, for some reason they keep giving us a pass. I guess because we've got the greatest money printing machine ever in the Fed. So the point here is, what is risky isn't necessarily on the surface obvious. Most people, when they jump out of the market, will jump into the dollar or into bonds in the past, U.S. Treasury bonds. But that's where risk lies. That is a huge risk. And that's why you see big money managers selling out of treasuries, because there's too much risk involved. Not just default risk, but also, if interest rates rise, inflation risk, it's going to cream those bonds. So anything denominated in U.S. dollars, any debt denominated in U.S. dollars, whether it's corporate, municipal, or U.S. government, is going to be in big trouble. And if one gets downgraded, they're all going to get downgraded. Meaning, if the U.S. Treasury debt gets downgraded, everything under it and denominated in that currency, dollars, U.S. dollars, is going to fall too. So that's a big problem. So the point here is we've seen a great run in the market. Things are starting to slow down. We're not seeing the huge gains that we did see in 2009 and some in 2010. Risk is starting to creep back into people's mentality, but it's amazing how many investment advisors are still out there cheerleading this market and ignoring the fact that what pushed the market up in the first place, propped it up, and is still propping it up, which is the Federal Reserve and all of their monkeying with currency as well as interest rates. So the point here is you have to have an investment strategy. You've banked some gains. You have to have some points where you say, look, if X happens, whether it's a certain number on the S&P 500 or a moving average or whatever it is, you have to have a strategy. If you have no idea, poke around the Occam Planner website and see about the strategy that I employ, or even my website, Becker Advisory Services, and look at some of the strategies, some of the things that I look at for where to get out of particular investments or general markets. But I'll give you a hint. A lot of it revolves around the 50 and 200-day exponential moving average. So point is, folks, you want to have an investment strategy. If you don't, you need to find one. If your investment advisor does not, and here's something very clear. If you have an investment advisor, you want to ask your investment advisor, what is your investment strategy? And if they bumble around or tell you, we buy and hold investments because over the long term, run the other way. Run the other way. There has to be a strategy. There has to be something saying at a certain point, I'm going to take some money off. If it's guesswork, get out of there. You want to have an investment advisor with a strategy. Absolutely, definitively. So that's it for this post. Perhaps some more to follow up on this topic because it tends to be fairly popular with people that have no idea other than buy and hold. And that's all they've done in the past, which it worked in the past. But going forward, there is just so much risk baked into the market's cake right now that this is definitely a point where you want to have an investment strategy. Thanks, and check back soon for another post.